Hello, welcome back to the session of financial management. We are continuing with the topic Dupont Analysis. Very simple at the same time, very important concept, okay? Basically, Dupont Analysis is about analyzing an important ratio which is known as ROI, that is return on investment. This ratio is found to be the multiple of two important ratios, that is net profit ratio and capital turnover ratio. By analyzing this fundamental framework, investors and financial analysts can identify the factors influencing the ROI, that is return on investment. And this methodology introduced by DuPont Corporation, which is a market leader in the early 1920s, and this concept is introduced by Frank Donaldson Brown, who was an expert in the Treasury Department. Donaldson Brown came up with this revolutionary tool for financial analysis, and now it is widely used by investors and financial analysts. Okay, let's discuss what DuPont analysis means. And this technique is also known as DuPont control chart. And what is the benefit of DuPont control chart? Through this chart, we can make a detailed analysis of various factors affecting ROI, that is return on investment. For this analysis, two important ratios are used. First one, capital turnover ratio. It means sales divided by capital employed. What do you mean by capital employed? It means fixed assets plus working capital. And what is working capital? It means current assets minus current liabilities. Let's talk about current assets. It includes mainly three things, that is stock, account receivable or debtors, cash and cash equivalents, right? And what's about current liabilities? It includes sundry creditors, bank overdraft, short-term loans and outstanding expenses. So it is a decomposition of capital turnover ratio. Decomposition means breaking down the ratios into its fundamental factors. Clear? And the second ratio which we used for the ROI calculation is net profit ratio. Okay. What was the first ratio we used? Capital turnover ratio. Okay. This is the second one which I am going to explain. Okay. So what is this net profit ratio? It is found out by net profit divided by sales. So what is net profit? It means sales minus total cost. And total cost comprise of these five things, that is cost of goods sold plus administrative expenses plus depreciation expenses plus selling and distribution expenses plus financial expenses. So first item, what is COGS? That is cost of goods sold. It is the total of all direct expenses for producing goods. And what is administration expenses? It's wages, salaries, etc. And depreciation expenses? You already know it, that is non-cash expenditure, right? And then selling and distribution expenses, that is it's related to sales, for example advertisement, salesman's commission, etc. And last one, financial expenses, that is expenses related to raising capital. For example, if we are taking bank loan, we need to pay interest, right? So that interest we can classify as financial expenses. Similarly, dividend paid to shareholders. In the case of when we raising funds from shareholders, we need to pay dividend to shareholders. That dividend we can classify as financial expenses. So all these things are financial expenses, right? Thus, cost of goods sold, administrative expenses, depreciation expense, selling and distribution expense and financial expense. All these five things together make total cost. Now we got two ratios, right? One is capital turnover ratio, another net profit ratio. When these two ratios multiply together, we will get ROI, that is return on investment. Okay, so what is the benefit of this chart, or what is the benefit of this ratio? We can easily predict or estimate or analyze the basic factors related to the ROI, that is return on investment. That is, we can find out the underlying reasons for changes in ROI measure. That is, by decomposing the net profit margin, fundamentally you reached current assets and current liabilities, right? So what we can conclude? That is, any variation in current assets or current liability will ultimately reflect on the profitability, that is ROI. Similarly, any changes in cost of goods sold, administrative expenses, depreciation, selling and distribution expense and financial expenses, that is whether it is positive change or negative change, it will be reflected in the ROI also. Okay. That is, a financial executive or a financial manager can easily analyze what are the factors affecting the profitability of a company. When we analyze each fundamental item, we will get more clear insight regarding the profitability of a company. I will give you an example. Suppose the production expenses of the company become higher. obviously cost of goods sold will be increased. Subsequently, total cost will be increased. So ultimately, what will happen? There will be reduction in net profit, right? So if net profit reduced, it will affect the net profit ratio. A negative effect will happen, right? So that difference, that is the negative effect on this net profit ratio, ultimately affect the ROI, that is the profitability of a company. That's the logic here. Okay, that is when we correct any variations happened in COGS, that is cost of goods sold, net profit ratio automatically improved. Subsequently, profitability will be improved. Okay, similarly, the changes can be happen in any of these fundamental or basic factors, that is changes can happen in current assets, current liabilities, administrative expenses and depreciation, etc. Okay, that so these changes can negatively or positively influence ROI. So a manager can analyze the profitability status or the current status of a company through this tool. Hope I made it clear for you. Thanks for watching. See you soon with another video. Take care.